this session is not so much about DIYing in some respects. Really what Tony asked me to do, because you get a 3-line whip more than anything else, is talk about what you could do for yourself when it comes to investing your money, or where there are sectors around the globe that are worth looking at if you help your clients to invest their money, or if you're just giving guidance to them. But it is an added value session. The whole thing is going to be about things to watch out for if you're going to give guidance to your clients, and equally, if you're investing for yourself, what you should and should not do. So without any further ado, let's start with good places to invest money. So places that you could look now, at this moment in time, when it comes to investing your own money, or if you're going to give clients any guidance at all, let's look at PE ratios. What this slide shows you very briefly is that if you're investing in the US at the moment, then the PE ratio of shares is roughly just under 17 times earnings, and at the bottom end there you see Russia at 7. Now the reason this is interesting is because if you follow anybody like Warren Buffett, they always look to invest in companies that are exhibiting good growth prospects but at reasonable prices. And clearly if you're going to invest your own money or clients' money in the US at the moment, according to the PE ratio, you will be thinking to yourself, or should be thinking to yourself, that may be getting a bit too expensive for my tastes. So whilst PE ratios I think are a good general starting point, it's important to remember they're not the only ratio that anybody ever uses when it comes to assessing where to invest money. But what I think it helps us to see very clearly is that the markets where clients should be investing down here are often the areas where they're nowhere near. So Tony cracked a joke earlier on that I invest in Russia, and I do. I own a number of funds, Neptune Russia being one of them, Raven Russia being another one. Raven Russia is a UK commercial property manager who left the United Kingdom many years ago to set up in the ports of Russia and buying industrial warehousing so that as exporters sent their Cadbury's cream eggs and Gucci handbags, they needed somewhere to store them before sending them off to Moscow and St. Petersburg. And so Raven Russia is a fantastic commercial property investment trust, and as you can see it on ratios like this, PE ratios like this, the shares are decidedly cheap. You only have to look at, say, Gazprom, a Russian oil company which trades on 4 times its earnings. If you compare that to, say, BP, they're nearer 12 times earnings. Now, clearly, it doesn't mean you should put all your eggs in one basket. It just is a good starting place for you to think, how do I want to asset allocate my investment money? You'll equally see in some ways, I'm going to show you a quick slide here, what should you buy, sell or hold? And I ticked European equities. Now if we go back, you'll say, hang on a minute, Rod, that's trading at a PE of 15.5 times earnings, and I've said European equities is a good place to invest. So when you're looking at your portfolio, it's quite useful to remember that in the current climate, you've got an economic backdrop in Europe that suggests there may be more printing of money. And if that happens, then that will be beneficial for European equities. Furthermore, the PE of 15.5 only tells you that as a market as a whole, it looks quite expensive relative to, say, Russia or China. But at the same time, within that market, there will be plenty of companies that are paying dividends of anywhere between 3 and 6%. And there are many funds like the Argonaut European Enhanced Income Fund, which specialises in paying high dividends by loaning stock and getting a premium from lending that stock, which in turn enhances the income that it pays. So its yield is just under 5%. Which by today's standards, return on cash and so on, if those companies have solid balance sheets, all the stuff that you know all about, then that is a very attractive place for you to be looking at as far as your investments are concerned. Neutral on US equities and neutral on emerging markets, that's largely because, as I said, in the US, earnings growth has started to show through, so companies are delivering the goods as far as their profits are concerned, but at the same time that's already priced into the market. So you've got to be quite careful about buying US equities in the current climate because many shares are trading at much higher PEs than the ones that I've shown you geographically. So if you take companies with international distribution, you'll often find that their PEs are around 20 to 23 times earnings. And therefore you've got to be very wary about putting too much money in US equities. Equally, you'll see that I made reference to corporate bonds and government bonds with the red cross. Really what we're trying to communicate here is a very, very serious point, that there seems to be very little value to be had investing in gilts or government corporate bonds at all, largely because interest rates are so low. And as interest rates rise, the price of those bonds will fall. So it doesn't make much sense to be looking at an area which is already overpriced and is at risk of falling in value because of any modest increase in interest rates. What's worse, I want to give you a tip that you could give to all of your clients, as well as to your mum and dad or yourselves. We see way too often that many investors have pension funds, not exclusively, but pension funds are a classic example, that have a thing called a lifestyle option to them. Does that name ring a bell with anybody? There's a gentleman smiling over there. Does it ring a bell with you at all? What it effectively means is that individuals are being encouraged by big insurance companies, banks, generally big organisations who are providing group pension scheme arrangements to sign up to a contract that effectively says when you're in the last 5 years to retirement, we'll take all of your money and we'll ship it at 20% a year out of equities and into bonds. And just think about the seriousness of this. If anybody's coming up to retirement now, or is already starting that process, first of all, it's an automated process, so it's just happening whether they're paying attention or not. And I can assure you, people who are in group personal pension schemes are likely to be people that are probably not noticing this going on, but a lot of sole traders and self-employed people won't be paying attention to this issue that they'll have just signed a form for. It was a bit like Richard's point about contracts and guarantees. But the significance of it is that you could have 100,000, 200,000, £1 million, and if they're transferring that at 20% a year out of equities and into bonds, and then interest rates rise, which broadly speaking, most of us in this room can agree at some point they must, then that is very detrimental in terms of investment return. And actually, I think potentially quite a serious and dangerous position for many retirees. What's worse, and very few of the industry experts talk about this, is that there's 4 times as much money in corporate bonds as there is in equities. And there's a thing called a great rotation, which hasn't happened, but it is starting to show signs of happening, where these corporate bond holders, because of the ease at which money has been available to the markets, to companies and so on, are now starting to look at moving their money in the opposite direction to these lifestyle plans. They're shoving the money back into equities, which will all actually be beneficial for equities, but again, detrimental for people who've got these lifestyle options in their pension funds. Or, I can remember 2 old ladies came to my office once, and they'd shoved all their money, because they'd used Hargreaves Lansdowne, I think it was, on the site. They'd shoved all their money into corporate bonds because they wanted income. And that's how simple they saw the solution. I need income in retirement, my money's going into these corporate bonds. And to me, it's just lunacy. I think some more of these things will reveal themselves as the tide goes out. But there's no doubt in my mind, I think that's another one area that you could add value by alerting your clients to the issue that they should pay attention to immediately. The last bit about where the good side of investing money is where to put it, and there's a lot of comment in the media about trackers versus actives. Anybody willing to admit they don't understand what that means? I don't, but... Right, okay. The industry loves its jargon, certainly ours does, and there's a lot of talk in the newspapers about whether fund managers can actually do better than if you just buy the index. Now that index is sometimes referred to as the FTSE, and so what I wanted to show you very briefly was a 10-year performance of 3 funds. I've chosen 3 different sectors, and to see how they compare when it comes to matching an index. So an active is where a fund manager like this one here on the blue line is trying to pick stocks throughout the market over a 10-year period. And what you'll notice is there is a bit of a trend for these fund managers to start to outperform the market once investors have held their funds for a half-decent period of time. Because too many investors are short-term investors. They'll look at their statements every 6 months and they forget that it's long-term investing that makes the difference. So in the UK Equity Income Fund, it's outperformed by 200% compared to buying the FTSE 100. If you look at Jupiter Special Situations, that's outperformed by 184% over 10 years compared to its benchmark, the Euro Stoxx 50. I mean, you make lots of money in each, don't get me wrong, you make lots of money. But actually, the point here is don't buy into this notion that active stock picking fund managers are all bad when you hear these sort of statistics that say 84% of these characters don't outperform their benchmark. Clearly you have to pick and choose, but just be alert to the fact that probably, like everything in life, a balance is always required, but the outperformance over the long term, you can keep seeing in each case, in each economy, it's the long term that makes a difference with their stock picking skills. Okay, so moving on to the bad. Now, I'm not saying Barack Obama is bad, but we saw this picture on the internet. We think smoking is bad, okay? I want to be very clear about that. But we just thought it was a fun photograph, so sorry about that, Barack, but it was just a useful introduction to a case study, Invesco Property Income Trust. This trust is just about... Where's Richard? Is he here? Richard? Our guest speaker, he's legged it. Well, there's an insolvency case here. Show him begging. And sadly, okay, investors are just about to lose £150 million in commercial property. Okay, quick story, just a case study. It's about some things, how they can go wrong. So this is an investment trust which was launched in 2004. As you can see here, it started quite well. The property market, the commercial property market is what it was invested in. And because the commercial property market was showing strong signs of not only recovery but doing well, companies' balance sheets were strong, companies were therefore willing to pay higher rents, the fund manager decided to increase the gearing on the trust by 100%, both to expand the remit and to enhance returns. Unfortunately, we had the credit crunch. So you can see what's happened. Now, this is a fund that was worth around 450 million at outset. And the last part of the equation, there was an attempt to issue new shares here in 2010 to bail out the fund, but there was no appetite for it. And so what we're left with is investors not expected to receive any money back of the fund now, which stands at £150 million. Now, I can tell you there are lots of private investors in this fund. Most of the institutions get out somewhere here. They're not daft, okay? But private investors, your clients, are the ones who often suffer at this end. And that's largely because, where's the added value for you? They don't sit and say to their accountant, if they're DIY investors, or, you know, assuming they haven't got an advisor or you don't refer them to one, they don't actually think, I should be speaking to my accountant about what's going on with my investment here. Because had they done so, the accountant would have been able to explain the numbers to them why things were going badly wrong. And of course, one of the things that I get quite cross about when it comes to direct investing is whilst everybody likes to talk about price, how you save yourself a few bob when you buy online, they rarely explain how much or how little you actually really save. The difference between most advisors, or certainly Kohn Cougar, and buying online is 0.15% to 0.25%. It varies depending on trusts and so on. So the actual saving that people are making is far smaller than they realise. But the marketing is very good. People feel that they're getting added value because they're making savings, especially where lots of money is concerned. But worse than that is they don't realise, that they're foregoing all the protection that's afforded to them under the regulatory system. If you go to an advisor has to give you suitable advice and is therefore liable for unsuitable advice. Okay, moving on to the ugly. This is a picture, you can't really see it very clearly, of my house and my bathroom, one of my bathrooms in my house. And the reason I've got this picture up here is because I got a £1,500 water bill from Wessex Water because I'm on a meter. And that little piece of plumbing down there had been leaking slowly over a year, which of course I wasn't aware of because this was all tiled. And it transpired that that £1,500 bill had to go up to £3,000 because I had to pay a firm of engineers to come and locate the leak. And the water authority didn't want to go into the house because they don't. They say that's your responsibility. And then obviously I had to pay a plumber and a tiler to re-plumb and re-tile. Now, I incurred that cost because the plumber that worked on that pipe couldn't be bothered to go down to B&Q and get a £5 connector between a copper pipe and a rubber pipe. But I often think this is life, isn't it? It's the way things go, and I think it's the same with investment. People make silly decisions for all sorts of reasons. And one of the ones that I think most commonly comes across to me is that somehow big is beautiful. If you go to big organisations, big banks, big insurance companies, you know, private, this, that and the other, that somehow you've got no problems at all, nothing ever goes wrong, and that's where you always get the best value for money. But actually what we think is that most of these organisations rarely have what we call skin in the game. And this is interesting because Simon mentioned this to you in his marketing presentation. He said if you actually work with your clients and try and promote their businesses, you're likely to get some support back. Now, Diamond Discovery, you know, has always worked with the ICPA. I don't know if he's still working with the ICPA, he is. But Park and Bridge Wine Merchants in Acton, you know, these are people who own the businesses and therefore have a vested interest, like you do, in providing the best service and giving good quality advice. It seems to me that when we talk about firms, I know these firms can sort of pay these fines. I think, yeah, that one's 300,000. I think that one was 500,000. But it shows you that this assumption that just because a firm is small, it's of no substance, is completely wrong. I wanted to finally give you some things that we've experienced over the last 12 months that reinforce this point. Okay, I said we have to give advice that's suitable, and therefore we issue suitability letters. Here's one that we think is a classic. This came from a large FTSE 100 listed financial advisor firm, and you'll notice the word in the letter. We found the wording, "You have chosen to allocate monies to the following funds." This is really serious and really bad. If you sign a letter effectively agreeing to that or take out an investment, it clearly says you have chosen to allocate monies to the following funds. But what was the point in getting the advice if you've chosen them? It's a complete nonsense. And this came from a FTSE 100 firm. Investment bonds for basic rate taxpayers. We don't get this. We see it all the time. Why would basic rate taxpayers have an investment bond, especially if they're not utilising all their allowances in ISAs, or NISAs as they now like to call them, and pension funds? An investment bond is a product that is very suitable for high rate taxpayers, particularly offshore, but it's particularly unsuitable because within it there is a basic rate of tax at 20% paid, whereas of course basic rate taxpayers only pay 18% capital gains tax. So it's a nonsense for them to want to do this. Hidden fund charges, one of my favourite subjects. We've written an article on this, which is available if any of you want it, but one of the things we're increasingly coming across, again, amongst large organisations, is that within, and I won't name names, but, you know, just think of large financial institutions. What they're able to do is create their own funds. So if you had any money invested with a bank, and you get your portfolio statement, and you see references to our managed fund, are fund number 1, fund A, fund B. It doesn't matter. They're all sorts of generic names. What you don't realise is because they've created those funds internally, they do not have to disclose their charges in the same way that an independent firm does. And it's a really good wheeze for hiding all sorts of charges. So we found one bank that charges 1.85% a year to operate an ISA. Now, in a period of low investment returns, that's pretty tragic, because that's going to eat into your returns, and it's very common, and again, it's something that I just think you could highlight to your clients, whatever they're doing, and to yourselves, that these are areas that you need to watch out for. Risk questionnaires are another thing. Tony, you had a particular point about this. Do you want to just elaborate your thoughts on that?
I was just saying that whenever people are going and talking to friendly IFAs, if we can call them that, they've always got one of these risk questionnaires, and they always are, strangely enough, it ends up saying what they were going to offer them at the beginning. And I think, I know you have a risk questionnaire which I think is very good, and perhaps if you want to get the risk questionnaire, just get in touch and we can get you a copy of it, so you can just pass it to your clients or get your clients to fill it in, and then you will get a genuine feeling for how adverse to risk or not your clients are, and it's very important to know that. That's really
well. I have to add to that as well. I often
you don't have to do that, Roddy, anyway.
Sorry?
Do you not have to do that?
Oh, we do. If you're using a professional advisor, I mean, Kohn Cougar's qualified through the Chartered Insurance Institute and the Securities Institute as well. So our membership of those professional bodies is legion in terms of the things that we have to do. But actually, we just see it as normal day-to-day stuff. I think where I think it's nice Tony says our questionnaires are good. But I find a lot of bureaucracy is a lot of nonsense. You've really got to get close to the client and understand the client's capacity for both understanding what you're proposing, but also their personal circumstances at a level where you know damn well whether it's right or wrong to be doing what you're doing. And it's as simple as that. Risk questionnaires tick a regulatory box. Many of them are, what's that saying, rubbish in, rubbish out? And it's a great saying, really. But they tick a regulatory box, so when the inspectors come around and look at the files, there's a form on the file that says this is what you did. But in reality, I think they're flawed, because personal circumstances vary so much. Again, Richard was using this in the insolvency side, that you really can only use it as a guide. Okay, so although I think our questionnaires are good, they're just a bit of a guide to at least start a conversation, and then from that conversation, work backwards or forwards.
So certain categories of funds aren't restricted then, if they want a super cautious fund?
Great point. Absolutely. I mean, I think if they want a super cautious fund, you should probably be telling them not to invest in the current climate. Nobody should be investing who's cautious at the moment. If you're a wary investor, don't bother. Keep money in cash. Wait for an opportunity that might arise. Cautious investments are typically things like gilts and corporate bonds. And whilst there's a market for them in terms of the fact that pension funds have to hold them, oh, and guess what? Those lifestyle funds, imagine how many hundreds of millions are being switched every year for the next 5 years into these funds. So there is a market for them, but it doesn't mean it's good for you, and it doesn't mean it's good for family members, and it doesn't mean it's a good investment. So cautious investors stay out of the markets. These markets, the reason I showed you the PEs earlier on, is because these markets are fairly fully valued, and it's actually quite hard to find areas to put money where if you're a short-termist investor, if you're cautious, if you are just looking to find value, they're not going to come in the core areas with Diageo and Vodafone and so on. All of these companies, although they have, again, international market exposure and dollar earnings and so on, the reality, all of these companies have been overbought, because there's been a tendency for the market to buy large cap companies that are providing these dividends. So looking around, smaller companies is probably a good place to look, but not until interest rate rises gain some traction, because they're going to have a hard time as soon as interest rates go up, because of the debt on their balance sheets. So it's a difficult market for investors at the moment, okay? It's not a great opportunity. But all I was trying to do is give you an overview that really PEs are a good starting place to look. People like me who are experienced, but also who are very long-term investors, like buying equities that are cheap. It's as simple as that. And I worry less. I take into consideration things like currency, but we, Kohn Cougar, use hedge funds. So I don't mean hedge funds in terms of 2 and 20s, as they're called. I mean we hedge the money back into sterling to de-risk the portfolio against the currency movement. So the ruble, the dollar, and so on. Okay? In summary, I said I'd talk to you about good investments, bad investments, and ugly practices. So if you'd like a car like Tony's, this is our Anthony, this is I'm talking about, invest in cheap markets. If you want to own a house like Tony's and have a view like Tony's, look out for gearing in investment trusts and make sure your clients are aware that you can help them. And if you want to own a holiday home like Tony's, I'm not saying it has all these things, get good advice from people with skin in the game. Ladies and gentlemen, thank you very much for listening.